This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Peter Mallouk. He is the president of Creative Planning LLC, which is a comprehensive wealth management firm. We're talking the full enchilada comes under Peter's umbrella. Investment management, financial planning, charitable giving, retirement plan consulting, tax service, and estate planning services. His firm has $50 billion in assets under management. Peter's got the chops. And he also happens to have a new book with one of my favorite people, Anthony Robbins. Everyone knows that Anthony Robbins in the last few years released a book about money, a fabulous book, some great insights, some of the great traders that you all love and know in Anthony Robbins' book. So it struck me that when I saw Peter and Anthony's book together, it was time for a conversation. Without any further delay, let's jump right into my conversation today with Peter Mallouk and talk about all things money. Because he's more than just trading, more than investing. In fact, he would not call himself a trader. I want to clarify that. But the full life cycle, the full history of money that has to take place in all of our lives, Peter is right there with that experience. I hope you enjoyed this conversation. I got to tell you, I would not be having a conversation with you if I did not pick up a book in 1994 called Unlimited Power, and I did not read that perspective by that man who's the co-author of your book that we're going to talk about today. So tell me, how did you guys connect?
Well, kind of a really roundabout story. Tony Robbins had a 401k plan at his work, and he, just like every pretty mid-sized company, had a team that kind of handled HR and finance. One day, a guy named Tom Zagainer comes in and says, "Hey, I've got your 401k plan. I looked at it. You're paying 3 times as much as you need to. You should be using some lower cost funds, paying less for admin, less to the advisor. Here's how it works." The finance HR people saw that. They switched the plan. Tony said, "Hey, why is the plan switching?" They explained he has to meet Tom Zagainer. And the next thing you know, he's invested in his company called America's Best. But he started to learn the difference between an independent advisor and a broker, a fiduciary and someone who's not a fiduciary. And then he got mad. He had money at brokerage houses, and he started to learn that he was paying too much and that the people he was working with didn't have to act in his best interest. He talked with his personal advisor, AJ Gupta. He also started talking to his clients. Like, he has clients like Paul Tudor Jones. He's got Ray Dalio and folks like that. So he had kind of the top hedge fund managers in the world to talk to Jack Bogle, Alan Greenspan, Charles Schwab. AJ said, "You should turn this into a book." And so he created Money Master the Game, which had interviews with dozens of people like that.
Great book.
I think it's still the best-selling finance book of the last 20 years. A bunch of my clients started walking in. I'm the owner of Creative Planning, and we're a private wealth manager. We work with individuals and 401k plans, and a lot of clients were coming in with this book. I read the book. It said, don't market time, keep your costs low, all the stuff he learned from all of these people. And then by coincidence, a couple of months later, his advisor had been getting overwhelmed with referrals from people reading the book, and his advisor got a couple people together that he would send clients to as well. We all got to know each other that way. AJ Gupta wound up coming to Creative Planning. Tom Zagainer wound up coming to Creative Planning. And so did Tony. The rest is history. It's an incredible story of him figuring out for himself that for 30 years of his life, he'd been paying too much and his taxes hadn't been controlled, and he's paying people to market time and things like that. That was what my whole career was based on. And so it was an interesting convergence that took a long time to get to.
Were you familiar with a lot of his stuff in advance?
We had a person that built our 401k team. He's since retired and has gone on to write a book and make a movie, but his name was Bob Pascuzzi, and he had been to a Tony Robbins event when he was maybe in his early 20s. I'm talking like a long time ago, like in the 80s. When I would go out on 401k plans with Bob, he would always play little pieces of Tony Robbins tapes. Bob was a huge fan. He would leave me messages in the morning of Tony and other people, Jim Rohn and others that are kind of really into self-help. And so I was familiar with him, but I'd never read a book, never bought a cassette, never been to an event. But I knew that there was this incredibly successful person at Creative Planning, considered the turning point of his life, going to one of Tony's events. So I kind of indirectly had known him. I remember when Tony came on board and him and Bob met, Bob still was carrying a notebook from this meeting he went to in the 80s, and Tony instantly recognized it. And it was a lot of fun watching, probably one of the highlights of my career, watching those two meet for the first time.
His energy, and I can think back to the, late 80s, early 90s as well, when he was on TV early. And I think some people would hear his message and maybe see the energy and they would get confused. Maybe they'd say, oh, his personality is too strong or something like that. But for me, it was always like, what is he saying? I was always just keyed in on the words. People can like this personality or that personality, but I always loved his words. His words just instantly just kind of hit me. And I was like, that's the way to think.
I think that the perception of him is very, very unfair. I mean, as I've gotten to know him, and I'm like a pretty even-keeled guy, so we're kind of an odd couple. When I look at people, when they say, oh, I don't like Tony, I go, well, what is it you don't like? Music, and there's jumping up and down, and he's yelling, and sometimes he cusses, and if you go to his events, it's cold, and it's very rarely the message that anyone talks about. And I'll just tell you about one day and then one separate story. So there was one day I went to a media tour with him for our last book, Unshakable. So the path, which we're talking about today, is about how to build wealth, protect it, transfer it. But Unshakable was only about the markets. The path touches on the markets, but it's about everything. Unshakable was only about the markets. And we spent 2 days together. We were getting off a plane, and a pilot came across on the runway and said, hey, I had to come see you, Tony. You changed my life, and went into the story about how he beat alcoholism, watching Tony at an event. And then we were at Bloomberg and we're in a waiting room, and a very famous biographer came over and talked about how he changed his career after going to one of Tony's events. And we went to dinner, and a woman came over and in tears talked about how he had impacted her daughter. This was in a span of maybe 36 hours. I told my wife, I don't know who else I could have been with that would have had so many people go to him and tell him that they changed their life. Before I ever met him, I have a friend in Kansas City where our headquarters is, and he was telling me a story about his son, who was my son's age, who was a teenager. His son had just fallen into a deep depression. It was not explainable. It wasn't in the family history. Gotten so much that one day at dinner, their son just got on the floor and curled in a ball and couldn't stop crying. And they wound up going to a psychiatrist, and was medicated, dropped out of school. And him and his wife were so worried with the son around the clock. They would give each other breaks. And one day he was going to go to a Tony Robbins event. The wife was going to stay with the son. The son said, hey, can I go with you? And so the dad was like, absolutely. So the son goes with him. Anyway, comes home from that event, stops his medication, stops going to the doctor, starts going to school. And we're talking now, it's 5 years later, and the kid's almost out of college and everything's great. Now, I'm not saying that's how it works for everybody. Obviously, it doesn't. But I'm saying the idea that he has no impact, it's just stupid. It's not true at all. And I think that there are a lot of people. I've sat with two people that are billionaires that go back the time of their change in their career as being sitting in an audience at a Tony Robbins event. There's one person who talks about this very publicly, Mark Benioff, who publicly talks about how that was the turning point in his career for getting Salesforce going. So it's clearly had an impact on all kinds of people that is positive. And you might not like the way it's delivered, but it works for a lot of people.
Fun thing for me is I didn't get any of the delivery in person. It was just the book. And for me, it was just before my career had even started, but it was his insight to say, if you want to be XYZ person, go be around those people, go get close to them. And that's how I ended up getting close to so many of these great traders that I was able to learn from and write about, was literally taking his advice of, don't think there's a wall there. There is no wall there. Just go. And it was just that simple advice coming from a book, that trigger. And it was like, so everyone's going to take and everyone's going to have a different piece that works for them. But that was what did it for me. And I would not be talking to you if I did not do that.
Yeah, I agree. He's got a lot of messages like that really cause people to think, why not me? And what do I need to do it? I mean, his big message is, you want to be something, and what are you doing today? And are the things you're doing today congruent with what you want to be? And for most people, the answer is no. You can say, I want to be ABC, but are your behaviors from when you get up to when you go to bed, are they making that what you want to happen more likely to happen or not. And I think he's very good at getting people to just cut through all of the noise that's out there and focus on things like that, and then give you the shortcuts of how to get there. Like, hey, you don't have to reinvent the wheel. Someone's probably already done what you want to do, and how to learn from those people.
Let's go big picture. Let's start to pick apart the financial services space a little bit. And I want to use an example that I've talked about in this podcast before. I can remember my CPA telling me in the late 90s, I was a couple years into setting up my business. He said, Michael, it's really easy. Here's how you should think about it. It wasn't a planner or anything. He was just a CPA. And he said, Michael, just get $2 million free and clear in the bank and you'll get 6% a year interest.
Yeah.
That was the late 90s advice, right?
Yeah.
So let's talk about the landscape. Since the dot-com bubble to where we are today, it has been one crazy 2-decade ride. To me, it feels like 1999 was just the other day in many ways. But it's been a crazy up and down ride, hasn't it?
It's been really unbelievable. So on the one hand, if you invested your money back then, and you just even held an index, from the S&P 500 from then to now, you made a ton of money. But what you went through was a crash course in markets. We know the average bear market's 20% drop or more, and the average one's 34%. We've had 4 or 5, depending on how you want to count them, over the time you reference, but the big ones are 9/11, the tech bubble, 08, 09, and now coronavirus. But in there were 3 of the most severe in history. So 9/11, the tech bubble, 08, 09, these are 44 to 56% drops, way beyond the average. And then coronavirus, which was average in drop, but the fastest drop of 34% in history. So many people did not participate because they went to cash or went partially to cash or tried to time their way through this and so on. That's one takeaway from that period. The second is it's hard to hold the market down. Despite all of these things, the market finds a way to go on a new high and go on a new high and move on and move on. That's, to me, is a big lesson. And the third goes back to what you talked about when your friend told you, get $2 million in the bank and earn 6%. Part of what drove this market is interest rates dropped over this entire multi-decade period to record lows. So if you put your money in the bank now, you lose money on a real return basis. And in a lot of parts of the world, you lose money even before a real return basis. You put $1,000 in the bank in a country like Germany, you don't get $1,000 back later. You get $990 back. You have to pay the bank to put your money there. In some parts of the world, interest rates are negative. Part of what drives returns is what can people get in the bank and what can people get in bonds. If you get 6% in the bank and 8% in bonds, you're less likely to invest in stocks. But when rates are close to zero like they are now, you're more likely to invest in stocks for a lot of reasons. That's just one of them. We've seen a lot of things that are new. How fast a market can go down, how frequently a market can go down in a short period of time, interest rates dropping, bonds as an asset class kind of going away, on their way to going away. All of these different themes happening at the same time.
Let's talk about the bonds and the asset class potentially going away and keep it at this interest income for a moment. You've been in the space for a decent amount of time. When you talk to people, the messaging from 10, 15, 20 years ago, what you would say then and what you would say now is very different when it comes to bonds and income. It's an entirely different psychological helmet to put on because things that my grandfather would have heard and what he did, having a nice muni bond portfolio in the early 90s, tax-free, big returns. These things don't exist. It's quite a change for people to say, gosh, okay, there's no more, quote, free income. Now you got to put it all in the stock market. Psychologically, that is a different thing to get people on board with, isn't it?
Yeah, it's a very, very different thing. And I'm fond of saying that yield without risk does not exist. It just doesn't anymore. If you hear that something pays 4%, 5%, there's some real risk associated with that. You just can't do it the way you used to. Volatility in bonds is very different than stocks. If you invest in bonds, you might be down 1 in 10 years. At least it used to be that way. With stocks, you're down 1 in 4. When bonds go down, they go down a few percent or low double digits. When stocks go down, they go down 30, 40, 50%. They're very, very, very different risk profile in terms of risk being volatility. I think in terms of actual risk, which I define as loss, I don't think there's that big of a difference. If you're loaning money to Nike or you own Nike, if you get the bond, you're going to get paid back as long as Nike's in business. If it's going to be in business, you may as well own the stock or you're probably going to get a better return. But this idea of getting the yield without a lot of volatility, it's just not there anymore. The bonds should really be a part of the portfolio just to meet your shorter term needs now, and that's about it.
Speak to that point you made. You said if you can get 4%, you think it's risk-free off some bond or interest income, whatnot. Explain to people why, if they think they're getting some 4 or 5% today, there's some trick hatch, some magic door in the back that they're not seeing that's got a risk that they're not understanding, because that 4% doesn't exist.
The way to look at it is always to go back to the Treasury. If you loan money to the federal government, we call that a Treasury bond. And if you loan it to, say, a county or a state, we call it a municipal bond. If we loan it to a corporation like McDonald's, it's a corporate bond. And if it's a corporation that's not doing great, you might call it a high yield bond or a junk bond. So let's start with the Treasury. The Treasury is what most people would consider the safest investment in the world. If you loan money to the federal government of the United States, there's a problem paying you back. They'll tax people more or they'll print more money. Okay, they're going to give you the money one way or the other. If that bond defaults, the world is pretty much over. So that's as safe as it gets. That is well under 1%. Historically, the average is about 6. Even the nearer term average is 3 to 4. But now today, you would get between 0.5% and maybe 0.8%. Really, really, really low. So a municipality is going to pay you a little bit more than that. A corporation will pay you a little bit more than that. A corporation in trouble might pay you 4, 5, 6%. Whereas in the past, they would have had to pay you 13, 14, 15. No one is going to pay you 4 unless you're going to take significantly more risk than the Treasury. They're always going to just pay you a little bit more. Like if the Treasury is at 5 and the good corporations at 6, the high yield is going to have to be at 10. If the Treasury is at 0.7, a great corporation's at 3, then the high yield, it's going to be at 4, 5, 6. That's the difference. If you're seeing that 4, there's a reason it's paying several 100% more than the 10-year Treasury. You're taking some kind of risk. Otherwise, other people would buy it and drive the yield down. They had to put it at that level to entice people to come over and invest with them over the alternatives.
I'm thinking of some older folks that I know. I'm in my 50s. How do you talk to them when they see the rates having come down over the last couple decades and they see the rates so low and they know their choice is only the stock market pretty much? How do you explain to them that they should not have any fear? Why should they be looking at these low rates and not be thinking to themselves, gosh, this seems unusual. Why are rates so low? Does this mean the overall economy is doing not so good, even though the stock market's at all-time highs? How do you respond to some of the older folks that start to look at it that way?
I would never tell people not to have any fear. I mean, there's definitely a lot of ways to lose money. Part of the way you cover yourself there is you just say, look, I'm not going all in on one thing, even the U.S. stock market. I'm going to diversify, because none of us really knows how every scenario can play out and what the consequences may be. And I don't say don't invest in bonds just because now the yield is terrible. My feeling about bonds is if you need money for the next 5 years, even though the stock market over the long run is almost certainly a better investment, we can't guarantee it. Even if we could guarantee it, we don't have any idea over the next 5 years what's going to happen. Sometimes you have a 9/11 and tech bubble back to back. It takes 5 years to get through it. Sometimes you have something very severe like 08 or 9 that takes 5 years to get through it. This coronavirus bear market literally is nothing compared to those 3 bear markets. So if you're invested 100% in the stock market and it collapses tomorrow and it takes 5 years to dig out and you're withdrawing your 5% from your portfolio, you can quickly find yourself broke. I mean, you really would have a hard time recovering from the withdrawals over the 5 years while your portfolio is depressed. There you have to be in some kind of high quality bonds that are shorter and intermediate term to meet those needs. So you're earning something, but you're not at the mercy of the market. Now, once we stretch out our time in the market to 5 years, now our odds are well over 90% we're going to be positive. And over 10 years, it's 98, 99%. Having that shorter term covered in bonds allows you to have money in a diversified stock portfolio to meet the rest of your needs. And we know that while in the short run, there are things to fear, there are bad things that happen, we work through them over long periods of time. And that's how you strike the balance to meet your short-term needs and your long-term needs. This is very different than wealth maximization. If you're 50 and you're working and you don't need to touch your money at all for 10 years and you enjoy the markets and you enjoy trading and so on, well, a wealth maximization strategy would be to have no bonds and to be all equities all the time, right? And so you might even concentrate a little bit within that space. But that's not real people. Real people are trying to save money so they can get a pile of money So they can take out money for a period of time and then take out money for a long period of time. And they can't afford to be in the 15% that don't work out. Individuals has to look at it a little bit differently than somebody who has different kinds of goals.
Let's go to the big picture that I think you want to hear me say. The financial services industry is broken. People can already hear you're a straight shooter. Look, I write books. You wrote many books. You want people to buy your book. Okay, that's one thing. It's educational. When you write something and you can feel good about it, that someone's learning from it, hey, that's capitalism. You provide a service and that's the way it works. People can hear that you're a straight shooter. Why is the financial services industry busted? What's wrong with it?
The core issue is that most of the people delivering advice own a product. Their company owns a product. Whether it's the big private banks, like the JP Morgans and the Goldman Sachs of the world, or it's the brokerage houses like the Morgan Stanleys and Merrill Lynch's, or it's the insurance companies where you might be meeting with somebody that says they're a financial advisor, but they're working for an insurance company. They work for a parent company that has products. And that doesn't make them bad or evil or anything like that. But if we applied this to any other area, everyone would run in the other direction. Would you go to a Ford dealer and pay them a fee and ask them what car to buy? No. They might have 20 different kinds of Fords, but they're going to recommend a Ford. Would you go to a doctor who owned 10 or 12 different medications and say, what medication should I get? You're going to get the medication that he invented and he created and he gets paid more on. We intuitively know to separate advice from product. When we do a Google search, that's what we're trying to do. We're trying to get advice on what product to go buy. But financial services is the one industry that has somehow withstood this common sense notion that advice and product should be separated. You still have thousands of advisors. I mean, creative planning is not the only company in the world that separates financial planning and investment advice from the product. There are literally thousands and thousands of advisors that do that, but they're in the minority. I mean, it's maybe 8 or 9% of advisors that are in that group. The huge majority of people that call themselves financial advisors, they work for companies that sell their own products. They have their own mutual funds. They collect back-end fees called revenue sharing. They collect front-end commissions. They get paid overrides for using certain products that their employer happens to own. And I think when that happens, it's not surprising that you won't perform as well as someone who's looking at all the fish in the ocean instead of just the fish in their little pond. The main problem is, in America at least, an advisor is not legally obligated to act in the best interests of their clients all the time. Brokers are not obligated to act in the best interest of their clients all of the time. An independent advisor on all the investments is all of the time, and part of that's separating the product from the advice.
What's the draw? What's the draw for folks that want to be with the advisor, the broker, the whatnot that has their own product? Is it just the kind of salesmanship? Is it the make you feel good thing, kind of like going into a Lexus showroom or something? What's the draw that keeps people in tune with that instead of kind of stepping back and being a little more objective, like you might be going to shop on Amazon? What pulls people in?
Well, I think it's just flat out a lack of knowledge. If you think about how does somebody wind up at one of these places? I mean, how many Americans picked up a phone and called an advisor at one of those places? I would say probably less than 1% would be my guess. Most of the time, it's somebody's approaching them. And so you just assume, well, I know this person, and that's the way all industry, if I go to my architect or my doctor or a lawyer or a CPA, they have to act in my best interest. This person seems nice and I'll go with them. I think they don't understand. And I think you see people are discovering. We started at the top on how Tony discovered. And as soon as he discovered, he interviewed Schwab and Bogle and everybody else and learned. And then he changed. His advisor, AJ, used to work at Morgan Stanley, and he became an independent advisor. I think that you see people doing this. There is a record amount of money moving from the brokerage houses to independent advisors as people wake up to this. And I think the combination of all the things we talked about that have happened in the last 20 years have caused people to go, I'm not just going to be with this person because I know them. I'm going to go seek out what I think is the best advisor for me, the most qualified advisor, and one that's independent. And between 08, 09 in particular and Bernie Madoff, those things really caused people to say, how is my money being managed? What can I do better? It just really changed. People became more proactive about seeking out advisors rather than just going to people The way you do insurance. Most people don't wake up one day and say, I'm going to buy a permanent life insurance policy. Someone sells it to them. Someone approaches them. And I think we're seeing that reversal start to trend in the United States.
Side tangent. What do you think about, in your position, pretty pragmatic, straightforward guy, people jumping in with both feet into crypto?
Every time I talk about this, I get assaulted on social media. But here we go again. I may as well own it. My thing about crypto is I wrote a letter about this maybe 4 years ago, and I basically feel exactly the same way today. There's thousands of cryptocurrencies, thousands out there. Anybody can start one anytime at their basement, name it something cool, and voila, you have a cryptocurrency. My feeling then is the same as now. 99.9% of these currencies are going to go to zero. Already, probably 99, since I wrote the letter, 99% have gone to zero, but another 99% of what's left will go to zero. There may be 1, 2, or 3 cryptocurrencies that prevail, hold value, and gain the confidence of the global community. Bitcoin may be one of those. I think people in the cryptocurrencies market would say it's not the best one, but it seems to be the one in the lead. Sometimes what's in the lead in the beginning seems like it's going to own the world, and it doesn't work out. That would be AOL. It looked like it was going to own the world. Then along came Lycos and Excite, and they looked like they were going to knock AOL off, and then out of left field, Google's the only thing we use today. We can do that with a lot of different things. Just because something looks like, hey, we invented this and we own this space, oftentimes they get toppled by something better that gains the confidence. So I look at it and go, I don't want to invest in all of these currencies because most of them are going to zero. I don't even want to think like 10 of them might work. They probably won't. Maybe it's 2 or 3. Maybe it's not what we think is obvious. So will something prevail eventually? Probably. Somewhere between maybe and probably. Is someone listening going to guess the right one? Maybe. Is that investing? Not really. That's speculating. There's nothing wrong with speculating if you realize you can suffer total loss. So if you're doing it for fun, or you have a small amount of money, or you don't have a lot, you need to risk it all to get to where you want to go, well, go for it. It may work out for you, but I would never take 5% of my clients' money and buy cryptocurrency and have a reasonable expectation that it was going to work out really well over the intermediate run.
Speculation in that context, the roulette wheel or the lottery, something like that.
Yeah, that's right. It's just, to me, it's just assuming that you've guessed the cryptocurrency that someone's willing to pay more for later because it doesn't have an intrinsic value. It's not producing income, pure speculation.
One of the turning points on this podcast was maybe 2014. I decided to stop talking only to market people, and I started shifting. And my shift started with a Nobel-winning psychologist, economics winner, Daniel Kahneman. I did notice in the path, you guys jump into the behavioral finance deep in pretty quickly.
Yeah, I'm a big fan of Daniel. I think that if you really look at how people screw things up, one of the big reasons is behavioral. And when you talk to somebody who says, oh, I lost everything with coronavirus or 08, 09 or the tech bubble, this is a very hard thing to do if you're in a boring diversified portfolio. I mean, your money has, even if you invested the day before 9/11 or the tech bubble or 08, 09, 10 years later, you more than doubled your money under all those scenarios. Pretty darn sure that's what's going to happen with people who invested the day before the COVID outbreak. It's the behavior that derails a lot of people. It's this hanging on to the winners too long, or not letting go of the losers, or going to cash and waiting for things to settle down. It's all of those mistakes. My first book is just almost entirely about this, 5 mistakes investors make and how to avoid them. And I touch on that in the path quite a bit too. In the path, we talk about how to accumulate wealth and how to grow it in the market, and then how to transfer it. And the part you're referencing as well, once we've got all these principles down, it's one thing to read about them. It's a whole other thing to live through a bear market and try to avoid those behavioral biases that are going to derail you along the way.
Let's talk about a word that is near and dear to me. I've beat this word up a good bit since my first book came out in 2004. This would be the word prediction. I'm still shocked after all these years that people really think, after considering the conversation we've had so far with all these ups and downs, I'm still shocked that smart people, really intelligent, high IQ people, seem to think that there is somebody out there that can predict tomorrow. I still just don't know where that comes from.
Is the whole man plans, God laughs should apply to the stock market and the economy. It's interesting because I think that we see that there are better people at almost everything that we watch. We can all recognize LeBron James is a better basketball player than most people. We can do that with any sport. There's someone who's a better chess player, and there's someone who's better at coding, and there's just somebody better at everything. And so we're used to looking at a space and going, this person does all these great things and they're in the top 1%, and I can apply that to almost anything in the world. And so you assume that applies to the markets, and it doesn't. So what we know is the market is the most efficient thing in the world, meaning that there are so many people on both sides of every bet, and some of them are very, very smart, and they all have the same information because regulators require that there be no inside information. It's very hard to beat. For your people that bet, that are listening, it's kind of like betting on an NFL game. The spread moves up and down based on, does a player have the coronavirus and is somebody injured or not? And it immediately prices in the probability of a win by a certain margin based on that. The stock market's that 20 times over. I love the headlines that say everyone is selling today. Well, there's a buyer for every seller. There has to be. People do get this concept with homes in their neighborhood. If you've got listeners and they've got 100 homes in their neighborhood and they're all between 300,000 and 320,000, that's sort of an efficient market. You probably list your house at 400, probably nobody's going to buy it. And if you list it at 200, well, you're stupid because you could have got probably 300 to 320. The market's kind of efficient. And if you wake up in the morning and it turns out that they're going to block your neighborhood for the next 2 years to build a prison next door, well, now all your homes are probably worth $50,000, right? It will immediately be priced in that this new event has happened. The stock market is pricing in every little thing every single second of the day. There is so many sharp people on both ends of it, it can't be beat. It's not perfectly efficient. There's some people who believe it is. I'm not one of those people that thinks everything's perfectly priced all the time, but it's priced well enough that the more you trade and the more you exit the market and go into the market, the more likely the typical person is to underperform than to outperform.
People see the headlines, they see the books and whatnot. There was a book, an author came on this show last fall, Gregory Zuckerman. He wrote a great book about famed trader Jim Simons. And I think people really need to, when they consider someone like Jim Simons, who's made just a bloody fortune and, is working at the, as you just noted, the upper beyond 1%. You're just not that person. You're not that person. I'm not that person. He's that person. And there's always going to be somebody in human history, as you note, that's on the edge, that's just got an advantage. You can't necessarily let that distract you from what you can do for your situation.
That's right. There's always going to be that one person. The question is, can the person keep doing it? I mean, look at Warren Buffett. I mean, he's really struggled, not for the last year, but for the last 10 to 15 years. Even if we find that 1 in 20 million or 1 in 200 million, or Warren was 1 in a billion for a while, and then you go all in on him and turns out you'd been better off in the S&P 500, it's hard for it to continue. And just statistically, there should be the people that outperform. I mean, like if we were just doing it based on luck, there should be somebody who pulls off outperforming for 10 or 15 years, but there's not a lot of evidence that suggests that that persists. We're seeing that now with people like Warren Buffett and Ray Dalio. And it doesn't mean they can't come back. It doesn't mean they're not just in a slump. It shows just how hard it is to outperform. If they can't outperform over the last 5 years, the idea that you're going to go home and beat all the pros, that's a tough task.
I think sometimes people don't realize, or they don't think about it when he's making so much money and burning the doors off. But then when somebody like Buffett, who's been fantastic, has the down spell, you ultimately have to look at it and kind of say, well, gosh, he had a relatively few number of big winners. And so there you start to have the diversification notion comes up. And then as you point out, well, then the S&P starts to look a little bit sweeter. The market is a beast. It plays for keeps, right?
If you're actually trying to get somewhere, look, The Path is not a trading book, right? You've written amazing trading books. The Path is about how to get from here to there with the highest probability possible of making it all work. How do I grow my money? What's the smart ways to invest it? How do I allocate my portfolio? How do I protect my assets? How do I transfer them? That's what it's all about. That's what most regular people need. They're just trying to get to a goal. They don't want to be at their computer all day trading. They don't want to be figuring all that stuff out. And even if there's a 10% chance that you can beat the market, why would you take that chance? with all of your wealth. I mean, you're basically going to bet your retirement and your kids' education on 10. What if there's a 50% chance you can beat the market? Why would you take that chance when if you don't beat it, you might not beat it by a very wide margin? You might really fall short of your goals. So to me, there's a risk reward here too. And again, this is separating out the people who want to trade for a living or this is their passion or whatever. But if somebody's just trying to get from here to there, the doctor, the lawyer, the architect, the person who's going to work at UPS every day and making 80,000 a year and just wants to make sure they can retire, you really want high probability investing under those scenarios. You don't want to be all in on 12 stocks and hope it works. The risk reward just isn't there.
I would imagine even in your field, in your office, you will still have very wise clients that will occasionally start to talk about day trading currencies and whatnot. I've kind of noticed in the last bunch of years that people are really, I don't know if they feel desperate or whatnot, but I just want to shake folks and say, gosh, just stop this idea of 5-minute bars and hourly trading and day trading and all this stuff. Just stop, throw it away. It's not going to get you there. You're going to lose. I just tell people, if you're going to go down this day trading path, you're going to lose.
Well, I would say even the professionals in this space, they know this. 2 examples, a person who ran an options company in Chicago. He's absolutely brilliant, had a lot of employees. He made $200-something million, and he put most of it with creative planning. And he kept some of it because he, in retirement, wanted to trade options a bit. Why would he do that? Because he knows that it's extremely stressful. And yes, you can hit grand slams and home runs, but you can strike out. And he's now retired. And he can't afford the strikeout. So here he's taking most of his money. And even though he made his living managing options, he's got that with creative planning. I have the same thing with hedge fund managers that are clients, that they make their living trying to figure out when to be in and out of the market and which sectors to overweight and so on. But they view that differently than their portfolio than they need for retirement. I'm not speaking about all of them. These are just the people I've had experience with. Most of my clients that are business owners, they go, look, I make most of my money in my business, but I want to be financially independent with a diversified portfolio. And so they try to take money out of their business and build that diversified portfolio with creative planning. You might have an athlete. We've got professional athletes that are making a lot of money, but they try to get them to that diversified portfolio as quick as we can. And the idea for that business owner or that professional athlete or whomever is let's build a diversified pool you can count on no matter what. Even the professional traders, like my options client, my hedge funds clients, and so on, they want that diversified pool because that's for their retirement. So yeah, they're still trying to hit the home runs and they believe they can do it. I'm not saying they're insincere. They believe they can do it. And in these cases, they did, at least for a good period of time. But when it comes to their own retirement, they want that diversified pool to fall back on too, because they know you can strike out with that kind of trading. And if you strike out, the game's over. You don't get to strike out. You don't get to strike out 3 times an inning for 9 innings with investing. Sometimes one strikeout's all it takes to make you have to go back to work.
Look, we don't live forever. That's the bottom line. We don't live forever. And the utility of money, I mean, you really have to think it through, because if you're 60, 70, 80 years old and you're trying to make 100% a year, which is insane, I mean, you're probably going to end up going to zero.
Yeah, somewhere along the way, you might be right 5 times in a row, but if you're wrong once, that's all it takes.
When I think of risk management, I really define it very much how you did. We've got the volatility on one side, but loss is really risk management. Losing money, there's where your risk really is. Speak to risk management from your perspective a little bit more.
Well, I think like you might have somebody who's got a lot of money in individual stock. And usually those folks, they don't want to part with it because it's what got them where they are today. I mean, we've got several clients that have a lot of Apple stock today, Zoom stock, companies like that. And they don't want to sell it because it's the horse that got them here. But you might protect that position by having stock options that protect, you give up some of the upside, but in exchange, you get a floor on the stock price. You might really believe in the stock market like me and have a long time horizon. Maybe you're in your 40s and most of your money should be in stocks. But if you're going to retire when you're 45, you need to have some of it in bonds, and you mitigate your risk that way. You mitigate a lot of risk through education by understanding how markets work and how diversification works. You could own 10 stocks and not be diversified at all if they're in the same country, in the same sector. So understanding all of that as well. And then there's risk management within wealth management outside of the stock market. I have a client in New York, and he had a party and someone fell down the stairs in his house and sued him, saying that they had a brain injury because of that. And his homeowner's insurance said, hey, this should really be covered by your umbrella coverage. And the umbrella coverage said, hey, this is really a home owner insurance thing. And this little tiny thing that most people would never think about becomes the thing that impacts this person's potential financial future more than anything else. That's risk management too. Protecting yourself against litigation or what may happen with a car accident or somebody slips and falls on your sidewalk and so on. When you're talking about, again, a person needs to think about all the risks that apply to them. There's a reason we get car insurance and homeowner insurance and life insurance, and where we insure our income through disability insurance. And for most people, their biggest contingent liability is that they may need a nursing home or full-time in-home care. All of those things and how you address them are part of risk management outside the portfolio. So you can be a great investor and lose everything because you never took the time to look at risk management outside the portfolio. And it's a boring topic, but it's something that needs to be addressed along the way, so you don't spend your whole life accumulating wealth and lose it over one of these stupid things you just didn't take the time to think about.
Yeah, there's no doubt. We're not going into the granular level in this conversation, but you've pretty much, from my perspective, the way that I would describe it, it's kind of like a cookbook, cradle to grave. I mean, you're really getting into the nitty gritty that everyone has to think about. In that example you just mentioned with this going down the stairs, I mean, I'm sure that's going to cause everybody, it just did with me, it causes everybody to think, oh, I didn't want to hear that. You don't want to hear that story because then it's like, somebody just thought of a risk that I didn't think of. Now I got to think about that risk.
Right.
Let me keep you at a risk that's unfolded this year. I would love to have your perspective. COVID. We all kind of know what's been happening this year, so to speak. How do you feel about the permanence of this? I'm sure COVID will go away at some stage, but how do you look at financial services? Are things changing in a permanent way? And what would those things be?
I think that what we're seeing is, so far, I don't see anything mind-blowing. I see acceleration of trends that were happening anyway. So we're already seeing retail die and giving way to the online services like Amazon and emerging Walmart. We were already seeing movie theaters die and give way to streaming services like Netflix and Amazon. We were already seeing people moving to video conferencing, but of course it's dramatically accelerated. All of these it's kind of like just taking what was going to take another 10 or 12 years and it's pulled it up so that it all happened in 6 months. I think those are more permanent things. Those are just the trends that have been accelerated. I'm not one of those people that thinks the world is turned upside down. Like when you hear people say, oh, whenever this is over, it'll take 3 or 4 years for hotels and air and all this stuff to get back to normal and everything's changed forever. I don't agree with that at all. I think that our memories are very, very short. I think we all like to get back about our business. And I don't mean when the government says coronavirus is okay, when people feel safe. When my mom and dad go, oh, I can get on a plane and I can go on a cruise, that's safe. I don't think we're going back to normal. I think everything's going to be booked for 3 full years. I think every hotel and every cool spot and every plane and every boat, it's going to be in the rearview mirror and everyone's going to get back at it. I remember going through this with 9/11 when everyone's talked about no one would ever get on a plane, and that, of course, wasn't true either. I think we've seen the acceleration of trends that were happening anyway, but we're going to see a lot of return to normal. I think one trend that was not on its way that might be different is the way we work. I mean, there are a lot of businesses that allow people to work from home. There are some that never allowed it. I think you're going to see more businesses offer it when unemployment is low. So I think the research is probably going to be out there that for some businesses where people need to work together and talk together, that work product is diminished if they're not together. For some, it doesn't matter. But for those where it does make a difference, you're going to see those employers have to bend in a marketplace where unemployment is low to accommodate people that want to work from home. So I think that is a new trend. But for the most part, I don't see the radical shift I think that I read about in the press every day being persistent.
You mean the press has a messaging? It's not just news anymore? Hey, one last thought, one last question. In your subtitle, the word freedom. Now, for you, a very detailed guy, all the details in your book, freedom is going to be a lot of different variables compacted together. But I think for the average person, they've got more of an idealized view of freedom. Speak to me without being the planner, without being the advisor for a moment. What is freedom today? Where are we? What do people want? What do they still think freedom is?
Yeah, I am a detailed person. And I think me and the team here at Creative Planning, we built this place on saying, well, Michael, you don't have time to think about the person falling down the stairs, but we're going to think about it. And we do it in a way where the client knows that we've covered every single aspect so they don't need to worry about it, that we have worked with them to clarify their goals, what they're trying to do. And how the money should be invested and why it will work out even if there's a bear market, and how to cover all those risks and how to make sure you can cover all the estate planning things that need to be covered. And we do that in a way that makes the client feel like we're not missing anything. Ultimately, what I'm trying to give that client is freedom. Not even the slightest hyperbole. That's really what I'm trying to give them, is I want them to have peace. So I think most people feel like they've got something figured out. Oh, I've got my estate plan right, or my investments are okay, or I know I have enough insurance. But we have this general feeling that we don't really know what's going on across our entire financial life. We've cobbled together a bunch of advisors in a bunch of different places to do it. Maybe something's missing. And because of that, there's this subconscious or conscious stress that's there. Sometimes it's one client, sometimes it's a married couple and it's just one of them, but it's almost always there for everybody on some level. I try to remove all that by doing what we did in the past, covering all the aspects, growing, protecting, and transferring. And what I'm really trying to give them is peace of mind and freedom. Freedom to just know they're on track, which reduces the stress level and allows them to enjoy life. And that's really what I want them to have. That's the ultimate success, is that they're able to enjoy themselves and enjoy what all this time, the tens of thousands we've spent earning money and growing money and doing all those things. It's not worth it if you can't just relax. If you're worried with every withdrawal that you're closer to going broke, that's not freedom. For me, I'm really trying to help people get that amount of money where they can feel secure forever and not worry about all the things that may take it away from them.
Great stuff. Great conversation. I enjoy listening to you. I'm sure this is how you connected with Tony. He probably sat down, started hearing you talk for an hour, and he was like, okay, here's my money. Something like that.
I appreciate it, Michael. I enjoyed the time with you today.
The book, The Path, Accelerating Your Journey to Financial Freedom with Tony Robbins. Peter, where can we send people? Where would you like to direct them to?
You can order the book on Amazon or at any major bookstore. You can visit Creative Planning at creativeplanning.com, and you can follow me on Twitter. It's Peter Mallouk, Mallouk, or Facebook or LinkedIn.
Peter, cool stuff. Keep me posted on the next book. There's always going to be another book, because once you've done a couple, you can't stop.
I think you're right. I'm already writing the next one. So
that's a good guess, right? Yeah, there we go. Hey, thank you, Peter. Appreciate it.
Have a good one.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, Trend Following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.